We think the market overall in Australia is fairly priced at a PE around 15 to 16 times, which is slightly above the longer term average. So we really need to see earnings per share growth come through to drive the market higher over the next 1 to 2 years. And post the reporting season hasn't quite given us the confidence yet in terms of the earnings outlook for companies in a number of different sectors. We'll see the market move significantly higher over the next 12 to 18 months. Companies are still focused on cost outs and struggling to get revenue growth in most parts, while some that is starting to improve, in particular the mining sector. But certainly the key focus shorter term are interest rates in the US. That will create significant volatility, we believe, in the short term in the overall direction of the market. We could see it retrace in this very, very short term and then potentially move higher as on the back of another interest rate cut from the RBA. Here in Australia over the next 6 to 12 months, consumer confidence, we watch quite closely, remain mixed on that front. So we still think that there are further interest rate cuts needed in Australia to take the Australian share market closer to 6,000. The US economy continues to improve, and they've done a good job in the last few years in holding back in terms of interest rate increases to really make sure that the economy recovers quite strongly post the deep recession they had in 2008 and 2009. So certainly we think there is, and clearly there is upside to interest rates over the next, say, 5 to 10 years. In the US, they'll do it very slowly and very methodically, as they've shown. But certainly equity markets tend to struggle when interest rates are moving higher. So we think that the propensity for the US market to outperform the Australian market is quite low, when in the Australian market we're still going to be, we believe, reducing the cash rate here for the next 1 to 2 years to try and stimulate economic growth and consumer confidence. Look, we're still holding cash levels around that 30 to 35% level, which is right in line with our longer term average over 20 years for WAM Capital of 34%. We are selectively finding opportunities that we are starting to invest in now post the last reporting season and rotating out of a couple of stocks that have reached our price targets and valuations. So certainly we are finding some select opportunities, but it's not sector specific, it's very company specific, companies within sectors that are growing against the grain, and we'll continue to try and find those opportunities as we go forward.
Any examples you can share with us?
Well, look, one that we think looks interesting at the moment is Hello World. That they are a travel agency business similar to Flight Centre. We think that they've got a new management team there. AOT, the assets that we've entered into that business, and then we think there's significant upside on the TTV that they generate to further drive margin over the next 1 to 2 years in particular. We think it's under-owned, again, under-researched by the market, ticks a lot of our boxes. We think that we quite like the outlook for that company in the next 1 to 2 years.
And any areas to avoid?
The outdoor media space. So APN Outdoor was clearly a negative result throughout reporting season, whereas QMS and RML were okay. And the industry stats are holding up in terms of the outdoor media spend. So we think that the outdoor media space as a whole has done quite well, and valuations look up there for us at the moment. The other sector which we're quite cautious on and have been for the last 6 or 9 months is the China consumer stocks, we call them, so Blackmores, A2, Bellamy's, BWX. We think that the regulatory changes are starting to bite in terms of their earnings. We're starting to see the Blackmores fourth quarter result that they called out a few weeks ago was quite negative. So we still think there's potential volatility with a lot of those companies as they adjust to those new regulatory changes and the shift in dynamics in terms of how products are entering that Chinese market compared to what they were 12 months ago.